Thank you for staying with Benchmark. As mentioned in our top story today, inflation is seemingly under control. But what are the prospects of higher oil and commodity prices? And where is the rupee, which has remained fairly stable, headed in the medium term? Anushan Selvaraja attempts to find the answers.
Welcome to the Voice of Business. Joining me on the show this week is economist with Standard Chartered Bank and LMD columnist Samantha Amarasinghe. Now, as you say in your column in LMD, the rupee has remained fairly stable, which contradicts your bank's expectations of a, quote, convincing downward movement on Greece-related concerns and global growth risks, unquote. Now, you attribute this to a lower level of short-term debt and rising forex reserves. Can you tell us more, and also where you think the rupee will head in the medium term and why?
Yes, on the first point, we believe the lower level of short-term debt has reduced the potential upside risk to the dollar rupee from unexpected flows. And in terms of the rise in foreign exchange reserves, this has increased the central bank's ability to limit the upside to the dollar rupee and even push it lower. So where do we think the rupee will head? Well, we have revised the trajectory lower to reflect greater appreciation than we had previously anticipated, and by year end we are expecting the dollar rupee to be at around 108.4, and in the medium term even stronger appreciation. So we're looking at 106 by the end of 2012 and 104.8 by the end of 2013. Our rupee appreciation view is based on three factors. Firstly, Sri Lanka's growth potential. It will remain strong and broad-based, and we expect exports to also remain buoyant. The gradual opening up of the economy leading to higher foreign institutional investor inflows as well as FDI flows. And finally, the central bank's comfort with the current pace of currency appreciation and their willingness to use the currency rather than rates to contain any renewed inflation risks.
It seems that you are not necessarily confident that the government will meet its FDI target of $1 billion this year, despite inflows gathering pace in the first quarter. Can you elaborate on this, Samantha?
Our concern is that FDI inflows in Q1 were heavily concentrated in just two sectors, tourism and telecommunications. And while we are cognizant of the fact that the government has taken comprehensive steps to provide investors with greater clarity on guidelines and regulations, clearly evidence of increased transparency and improved governance is necessary to attract investment into other sectors.
Now, inflation is seemingly under control, right, Samantha? How about the prospect of higher oil and commodity prices? Are we relatively safe on these fronts today?
Yes, inflation pressures have started to ease on account of domestic supply-side improvements and stability in global commodity prices. In fact, inflation in June was at 7.1%, and we're expecting it to average 7.4% by year end. On the oil price front, in fact, given the release of strategic stocks, which will prolong the weakness of US prices relative to global benchmarks, we have in fact lowered our forecast for ICE Brent in Q3 to US dollars 110 per barrel, and we expect it to trade in a US dollar 105 to 115 band. Our Q4 forecast has been left unchanged at 110 US dollars a barrel, and in fact we expect WTI crude oil to average $98 in Q3 and $100 in Q4. All in all, yes, we're relatively safe.
That was Samantha Amarasinghe speaking to Benchmark's Anushan Selvaraja. Thank you for watching our show. We'll see you again next week.